I'll say it over and over and over. That industry specificity and those relationships are so valuable to get the right deal done and not do damage to your brand if you decide not to sell the business. What are the steps? And how do you get to that point where you realize whether they're serious or not? Are they tire kickers? What are the numbers? Because like you said, you could waste a lot of time and get distracted because you're enamored or flattered by a phone call when it's really somebody just trying to dig information out of your company. So the hard part is a business owner, they're at their country club and their buddy tells them, I just sold for 16 times. Well, one, they're not in the same industry, but that buddy had all of these things really working from them on the financial side and probably had their house really in order to sell a business.
Hello and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. This episode of How to Exit is brought to you by Final Ascent, the boutique M&A firm helping lower middle market business owners achieve their ultimate exit. At Final Ascent, they know selling your business is one of the biggest decisions you'll ever make, and they've been in your shoes. Their team isn't just made of advisors. They're experienced business owners who have successfully navigated their own exits. Final Ascent specializes in preparing businesses for sale, building value, and connecting with a national network of qualified buyers who will compete for your business. They don't take on a client unless they're confident they can sell your business at the current market maximum value. Whether you're ready to sell now or planning for the future, they'll craft a roadmap tailored to your unique goals so that you can walk away with maximum value and a peace of mind. Start your journey today at Final Ascent. That's www.finalascent.com, because your next chapter starts with a successful exit. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Todd Sullivan, and he is with ExitWise. We're going to talk about the mid-market. I think you guys focus kind of in that mid and upper market type of deals, and we're going to relate that down to what the guys in our community do in the lower markets. But I really wanted to have you on here. I think you've got quite a bit of experience. You've had some great exits of your own, and you're doing some good stuff in the community. I want to get your perspective on a lot of things. First, thank you for spending your time today here with us.
Yeah, Ron, thanks for having us. We listened to your podcast, so it's exciting to be on, and hopefully we'll add some value to your audience.
I tease and say most of my guys listen to the show want to grow up and need your services someday. They're buying small to medium companies, and then they're gonna, when they come to exit, hopefully they realize they don't exit the same way they bought. Because if they make it past certain watermarks, they need different advisors, they need different, investment bankers, they need different set of advice. It's a totally different game.
Yep.
Once you cross certain thresholds in certain industries, it's different than others, right? It could be as low as 3 or 4 million in EBITDA in some industries, and it's 10 million in others. But at some point, you cross a threshold where you need to play with the bigger boys, and you have that insight.
Yeah, what's interesting is guys that have purchased businesses before are already ahead of the game, right? They've gone through some M&A transaction. They understand what it takes, just the sure willpower to get through an M&A transaction. Most business owners have not gone through that. So if you've built and you're doing your first M&A transaction, you're a bit at a disadvantage compared to somebody that's already purchased one, looking to sell.
So we always start off with the origin story, kind of who you are. Let's do that. Let's talk about who you are, how you got where you're at now, and then we're going to talk about ExitWise and why you and a couple of your partners built that. So let's focus on you first, so people can make that connection and know that they like you.
Okay. I grew up on the East Coast in Boston, Massachusetts. I grew up in a family of entrepreneurs. And I think that's important to say, right? Because it was very accepted to be an entrepreneur in my family. Went off to college, and I was a hockey player in college and got the chance to play professionally for a year afterwards. And I was asked to be a professional roller hockey player while I was playing ice hockey. I'd never done it before, and I put the skates on, and I said, "Oh, these are terrible. This is not gonna work." So I ended up designing a chassis system for the inline skates, and it made me faster. It made me more mobile, and so I patented what I had designed. Called a friend at MIT who created a couple of prototypes. We sent it out to companies in that industry, and I would say from beginning to end was about 22 months where we got a licensing deal. We started producing and selling the product all across Europe and got an acquisition offer for that company. So when that started, I really decided I want to continue to do that. I'm not going to be a professional hockey player. I was close, but I was just really a minor league player, and it was going to be tough to make a living doing that. So after selling that first company, went off to business school at the University of Michigan, graduated as Entrepreneur of the Year, and launched 3 additional companies, but they were mostly tech this time. I was one of the TechCrunch 50 out in Silicon Valley, and raised capital from some of the top venture capital firms in the world, and was able, fortunately enough, to sell those next 3 companies. So one of our companies was purchased by Microsoft, one by CBS, and one by the Ameris Sports Group. Sold another one to a strategic. So after my last exit in 2015, I really decided that I wanted to give back to my fellow founders, like my community, and spend, if I have 50 years left, right, give those 50 years back in a way that makes entrepreneurship easier for everybody, right? It's an incredibly difficult journey. And so I talked to a lot of friends that have built and sold companies, and we all really agreed that the M&A event is something that as business owners, we really know nothing about. Now, if you've purchased a company, you're, like I said, you're a step ahead. But if you really started something from the ground up or took it over from your parents and you've grown that and you're looking for a liquidity event, there aren't great resources to learn about M&A. It's really controlled by investment bankers or M&A advisors. And oftentimes their interests are just not aligned with yours. They are transaction people, almost like real estate agents for companies. And so we felt that my partner and I, who also, I went to business school with him, and he built and sold one enormous company valued well over $1 billion. We felt like we needed to protect our fellow founders when it comes to M&A. We need to educate them. We need to give them the tools to win. And that's what we do. We've been doing that for the last 5 years. We've had amazing outcomes. I think we deliver fantastic education. The statistics are significantly better than if you were to go to some investment bank and ask them to help sell your business. So I think we're doing a lot of good in the world, and we want to keep doing that.
The lack of information out there is starting to be corrected by companies like yourself. Even as short as 3 years ago, 4 years ago when I got into it, it was fairly scarce. I did my master's degree, my MBA in, I think I did it later in life, so I'll date myself a little bit, but it's just this. I think I graduated my master's degree in 2007. Yeah, in 2007.
Okay.
I don't remember them ever bringing up mergers and acquisitions, and I have an MBA in marketing. You would think in somewhere in school that it taught me. Now I knew the phrase or whatever, but you think I'd know more about it, like that. Yeah, that is a viable path. This whole entrepreneurship through acquisition wasn't it was only in the Ivies, and I did not go to an Ivy, right?
We had a fantastic course on it, and I agree with you. There's like a certain set of schools that not only focus on acquisition, business ownership via acquisition, but also kind of that search fund path.
Right.
Right, there are a few schools that are doing that. We've certainly sold companies to searchers, and I think it's a really valuable track.
A lot of schools are starting to take it up. In the last 3 years, I can think of about 4 or 5 times where I've seen news releases where, this school's picking up an ETA track, or or
Yep.
another school is. It's becoming more popular, and that's great. It's an amazing, and all businesses at some point change hands.
Yep.
Whether it's there's going to be an exit event one way or the other. You're either going to die in your chair and somebody's going to have to deal with it after you're gone, or you're going to deal with it during your life, right? If you own a business out there, somebody's going to have to deal with the transition. So the fact that it was not as well covered is a little bit of a shocker. But if you look at the grand scheme of things and the events that happen as an entrepreneur, like your day-to-day things are sales, marketing, accounting, customer relationships, that type of stuff. Exiting is one thing you do one time, right? Or,
Yep.
hopefully you get to do it more than once if you're good and you're a serial entrepreneur. So maybe that had some credence to reasoning to why it wasn't as popular. But that also lended itself to almost a predatory state. There's a state where, you know, companies all the time right now, a lot of times they end up wanting to sell or they were thinking about selling because a life event, something happened and they have to, or somebody unsolicited approached them, right, and
Yep.
said, "Hey, we're interested in you." There's a little bit of a shock factor in that for most business owners. Like they didn't think they were ready, and the curiosity gets them to wanting to hear what the number is. But that curiosity often gets them in trouble because that number is often low or even predatory.
I mean, you're really hitting on something there. We recently had a transaction with that I've told you about where a public company offered our client $5 million for their business. They'd been in business about 11 months at that point, but they'd struck a relationship with this public company. The public company liked what they were doing. And the CEO calls and says, well, first it was corporate development, said, $5 million. Come on over, we'll change your life with $5 million. You run this department. We're really excited to have you. We love the product. And he called us, right? And I could tell the longer story, but ultimately with very few phone calls, that offer changed from 5 million to $70 million. And so we have a playbook for companies and business owners who get these unsolicited offers. But the first reaction is, what do I do? They're asking for all this information. Oh my gosh, I want to know what they want to pay. I'm going to give them a bunch of info. I'm not going to get representation. I'm not going to get a non-disclosure signed. All of the things that you shouldn't do. And it's so timely that you said that, because after that, having this experience going from 5 million to 70 million and seeing that is actually repeatable, we're now putting together this kit really for business owners of like, what do you do? How do you answer that phone call? How do you initially respond? What are the steps? And how do you get to that point where you realize whether they're serious or not? Are they tire kickers? What are the numbers? Because like you said, you could waste a lot of time and get distracted because you're enamored or flattered by a phone call when it's really somebody just trying to dig information out of your company.
Sometimes what comes along with those unsolicited offers are unrealistic timelines too.
Yes.
I've had one where it was really small. I had a small marketing firm. One of my clients came down, and he joked about it 2 or 3 times during our sessions when I was helping him grow as a marketing coach and marketing client. I had to buy him ring in house. But when he finally came about it and said, okay, here it is, he made an offer. I had big whiteboards all over the walls, and he drew his offer on the board, and he showed me how he gave me money now, and I'd own a percentage of it. And I knew what type of deals he was doing. He's a real estate investor, so I knew what type of money he was making because I was helping him make it.
Sure.
And it looked really lucrative. And he said, oh, cool. This is like on a Tuesday coaching session. He goes, okay, you need to tell me by Friday or I'm going to bring somebody else in. Right. So I had to make I had a baby on the way, like it was significant money, it was a big chunk of cash up, for my world. He basically paid me what my agency would have been worth, or what we were on schedule to make that year, or in a 12-month period, and gave me equity in his company and a salary, a guaranteed
Sure.
salary, which if you own a small business, you don't have any guaranteed salary. If I lost a couple clients, my salary goes down, right?
Sure.
That happens all the time to these founders too. Somebody will come in and say, "Hey, we'd like to give you $5 million, but we need to know by next Tuesday."
Yeah, I feel like buyers, right? They have their playbook too,
Yeah,
and they're experienced buyers. So imagine going into a battle against an experienced tank when you're holding a butter knife. You are going to lose every single time. They know what they're doing, and one of the tactics is to pretend that the timeline is in their control when it is entirely in the business owner's control. Now, in your situation, you might have said, hey, that is a really attractive offer and I've got to get this deal done. We were just in that situation where a founder called us and said, oh my gosh, I want to get this done. I want to respond really quickly because they're offering a big number. And within 2 weeks, we realized he is talking to a junior of a junior at an acquisition firm who has floated a number with no backing behind it, only to get information out of this particular person. And to be hugely disappointed, 2 weeks later, finding out that this company had no intention of ever buying them. So there are a lot of kind of nefarious actors out there. But if you know the value of your company, if you truly understand it, and you feel like you're getting market rate or better, then and it is a serious buyer, it's something that you need to take into consideration. I think one of the things that every business owner needs to know is, like, where are you in this journey? Is this the right time for you personally to exit, to become an employee for somebody else, or to say, bye-bye, I'm walking away, and what am I going to do next? Who am I? I'm no longer the CEO of XYZ when I go play golf with my buddies, right? So your identity changes a little bit. I think that can be hard a lot of times for business owners. People that have purchased the business and don't necessarily see it quite as their baby and are looking to grow it and, flip that business, maybe it's a little bit different. But for most of the business owners we deal with, they have built this blood, sweat, and tears over long periods of time. And so there is a number component, right, to that offer, but is it the right time for you? We spend a lot of time with our clients trying to figure out, is M&A really the right option for you today? And if it's not, when is it going to be? And how do we position you to maximize the outcome 2 years, 3 years from now? We love those kind of conversations.
And it's brilliant to have that early on, to have somebody kind of shake your tree and say, here's an offer. And then they go to a guy like you or, an advisor of some sort, and they say, well, here's what that looks like. Here's the steps. Because now they're educated, and to some extent they have insight that when they are ready to exit, there's a process they need to go through, their steps. It's a multi-year process for most businesses, and they don't think they're going to sell it overnight. I see it way too many times where I talk to a business owner, I'm not ready to sell, but when I'm ready to sell, buyers are lined up. The whole market's talking about buying companies. Somebody will buy me overnight. I don't need to, I'm not ready to talk about it now. And I was like, yeah, but to sell, there's 2 to 3 years minimum of prep you need to do to sell.
Now, that whole exit readiness that you're talking about, that is no joke, right? Having your data room set up before buyers come knocking not only helps you make better business decisions and understand your own business and where you're going, but if somebody were to say, hey, we are interested and we'd like to see the last 3 years of financials, and that you can go somewhere and they're correct, and that you're projecting out into the future in a coherent way, it makes all the difference. We see deals fail because our sellers do not have a good control of their own financials, and they've been asked, hey, we'd like to buy your company, and they're just not ready. And to your point, it is not a 30-day exercise to get exit ready. There are so many things, from getting the management team correct to a buyer concentration, supplier concentration, all these little things that you can do to improve operationally and strategically within your business to elevate its valuation. I just encourage people to really take a look at that. You step outside your business, have somebody objectively view, what are the red flags? How do I get ready if and when, I get that phone call or I decide to go to market? It makes a world of difference.
So the other side of that is, you mentioned, when a lot of times during some of these strategic acquisitions, especially in the tech world and stuff, these companies are doing acqui-hires. They want the talent.
Yep.
A lot of entrepreneurs, myself included, make horrible employees, right? We're really great at building stuff. We're really great at coming up and, driving, a vision to fruition. But when it comes to showing up every day, clocking 40 to 60 hours and doing what some other division head tells you, because you're running your division, and you've got some EVP or executive VP that you're reporting to, or the CEO you're reporting to, that's a different game. And a lot of us just aren't wired to do that. And some of the people out there, they think they are, until they get in there. I've met so many people that are on earnouts, workouts, and those type of things, where they got to be there for 3 years.
Yep.
And by year 2, they're willing to give up the rest of their money to leave.
Yeah, you described me. I've had 4 exits. My last one, I really felt like I had a good understanding of the buyer, what they wanted, and I felt so underutilized and frankly, put in a basement, stay out of our business. like there was still that element of competition that the buyer could never let go of, that I felt, underutilized, not helpful. And after 2 years, though, I said, I'm done. We took plenty. It's this, I don't need to waste my time for 12 months. I'm going to go off and help other people. So, and I know that a lot of people can be in that situation where those dollars are so critical, to their lives, and that can be incredibly frustrating. And you're banging your head against somebody that you could never really work for in the real world. You would never do it if you weren't just selling your company. And you're right, they never last. I have friend after friend after friend where the earnout side does not last. I do that one that we talked about, 5 to 70. We structured a really nice earnout for him. And we gave him all the controls in his employment agreement to be happy, to be in the role that he wanted to be in and be successful. And so he is staying. And so I think there is an element of experience, understanding what you're getting into it and structuring it really well to find some level of success. But yeah, not an easy thing for an entrepreneur to turn into an employee.
What's the earliest that you end up talking to some of these founders and creators? When I say earliest, what is the normal trigger that has somebody calling you?
Sure. Well, we have a piece of software on our website. It's a valuation calculator. And we have, I think it's 400 business owners, or let's just say individuals, are using it every single day. And about 10% of those people, they create reports, they give us their contact information, and we reach out to them. And so I would say that we spend our time on businesses and business owners who have 2 million of EBITDA and up, right? That's kind of a general mark. But if it's a software business with recurring revenue, that tends to be about, call it 1 to 2 million of recurring revenue. They don't need to be a profitable company as long as a growth rate is there. So in either of those camps, we generally have the best investment bankers in the world, right? We are a platform of the best boutique industry-specific investment bankers in the world. That is what we do. And so we're building elite M&A teams for business owners. So whether you have a interior millworking business, which we've sold, a healthcare staffing company, which we've sold, payroll software, pet tech, fintech, real estate tech, there are a host of investment bankers that only focus on that area. And we pit them against each other and get you the best possible banker, then M&A attorney, tax accountant, all the things you need to be successful from a representation standpoint. The reason we have a cutoff of that 2 million of EBITDA is basically when you're finding the best person in the world to represent you, they need to get paid, and they don't take discounts, right? If you're trying to win an NBA title and I'm going to put, you pick the best athlete in the world in your opinion, if I'm going to put that person on your team, right? We don't ask them to do it for free. So it means that our transactions have to be, closer to 25, 50 million is our average. We go up. We have won 600 million, but I would say that really we play somewhere between 25 million and 150 million of enterprise value. So hopefully that answers the question. Their initial question really is, when do we start talking to them? We are talking to business owners that, are just starting. And so we will talk to them about what is the best way to set up your company, grow your company, with the goal of exiting it someday. How do I think about the exit as I'm growing the business? We love having those conversations, and we certainly have tools for those business owners, but we're not selling them. To sell you 2 million of EBITDA, or call it 1 million of fast-paced growth ARR.
So company comes out, they've been operating for a while. They've get something triggered their interest in seeing their valuation and seeing what they're truly worth these days.
Yep.
So they reach out, they do your valuation calculator, and then you have these conversations. Is there trends? You've been doing this for how long now?
4 years.
4 years. The industry changes over time. Even in the 2 years I've been in it, I've seen, for sale by, or you call it, Amazon. What's the word I'm looking for? Or the fulfillment by Amazon, right? You had that.
Oh, FBA. Yep.
FBA. That was hot for a while there,
Sure.
in crazy multiples.
Yep.
Now it's very well normalized, and a lot of those aggregators are in big trouble, right? And then you have SaaS with huge multiples for a while.
Yep.
Now it's coming a little bit more realistic. Do you see trends right now, or is there something that's like kind of heating up in the space right now?
Interesting. Heating up. So I just want to go back to your SaaS because I saw a report yesterday and we take a lot of data from our investment bankers, right? So we have private transaction data. We add it into the calculators database. And so we give far better results really than anything we've seen out there. And one of our bankers shared some of the SaaS multiples. And you have to go back 9 years to find where we are today. So all of that, the big hype in between 9 years and today really is gone. There are isolated instances when you have any company in any industry, if you have profitability, growth rate, and really strong EBITDA margins, those companies just get disproportionate number of buyers knocking on the door and it drives up price. So the hard part is a business owner, they're at their country club and their buddy tells them, I just sold for 16 times. Well, one, they're not in the same industry, but that buddy had all of these things really working from them on the financial side and probably had their house really in order to sell a business. So, listening to somebody at your country club is not the way to understand the value of your own business. I guess I kind of forget your question, Ron. Maybe you could rephrase it for me.
I was looking for trends, if there's anything heating up in the space right now.
We are seeing a ton of like mental health, pain management, facility roll up. We're seeing a lot of that. Certainly AI is really hot in the news, but I think we're starting to see our first few AI related M&A transactions where a larger strategic is saying, you figured something out, let's scale it now on our side of the house. So those are interesting to see. But I do think 2025 is getting back to more of the normal predictable state because interest rates are getting better understood. There's less volatility there. I can tell you over the last couple of years, fintech in general really got beat up because the heights in 2021 and 2020 were just so disproportionate to reality that that has really kind of come home to be normalized. I can't think of one industry in particular that is kind of seeing its day in the sunshine right now. There's a lot of pent up demand to acquire businesses. So your audience who's looking to acquire businesses, they are not alone. And what we have seen is private equity that's holding $4 trillion of dry powder is coming down into the lower middle market because they're not seeing the opportunities that are the $1 billion purchases as there are not as many of those. So you're seeing more competition for the best assets, basically in every industry, particularly tech. And when I say best assets, I'm really back to that kind of three-legged stool of profitability, growth rate, and EBITDA margins.
You glazed over something earlier, and I want to go back to it just because it's critical at our level too, in the small to medium business level, and that's industry-specific expertise, right? I've had people over and over going, hey, yeah, the SBA turned me down. I'm like, no, they didn't. The bank you went to get an SBA loan turned you down. And who did you go to? Oh, we went to our local branch of the,
Yeah.
credit union because they say they do SBA loans. I was like, yeah, but the local branch of your, you're in just one example, Tulsa, Oklahoma. The local branch of your Tulsa, Oklahoma credit union has never seen a software company in their life. They know medical and they know restaurants. I see. If you look at their loan history, that's all they've ever loaned SBA loans on. So that's all they underwrite.
Yep.
You went to the wrong lender. There is a very need here for people to understand that you need to go to people that know your industry. If you go to the right people that know your industry, the numbers change. What you need to do changes to some extent, right? If you're a software company in today's day and time frame and you have no recurring revenue, you're going to get dinged for it because companies expect some type of ARR, right? So, talk to us a little bit about the industry, why it's important to understand industry specific needs and stuff.
Yeah, I will take a second to get there. But initially, when we started ExitWise, it was free education, right? Trying to get our founders really smart about M&A, and hopefully they would improve on what was happening. And then very quickly, our venture capital firms that had funded me in the past would say, "Hey, you created great exits. Will you help us?" So we started selling businesses. And then we got to the point where we're not the best in the world at this. And we started really understanding that in the lower middle market, call it exits from 10 million to 150 million, the success rate when a company decides to go to market with whatever representation they've selected, kind of their local investment bank, or their board of directors has a friend who is an investment banker. If you select that person, your success rate is under 30%. I'm being very generous. It could be under 20. It's a tough thing to measure, but we have unusual access to this data. So I will say under 30%. When you switch to an industry-specific investment banker, you have a pet tech company that has an enterprise value of around $50 million. If you work with a pet tech specific investment banker that sells businesses between $25 and $100 million, your success rate goes to 85%. So think about that. Just by getting the right representation, your success rate goes up. Now, on top of it, your exit value for us, I know when you come to ExitWise and we build your team, because it's more the investment banker, your purchase price is more than 30% of what everybody agrees the company is worth when we start, right? So you've agreed it's worth 100 million, you're getting 130, right? Those are the statistics. It goes certainly beyond the investment banker. I think people very much overlook the attorney side. An M&A attorney, that is a serious skill set. And somebody that does M&A work may not be great at software M&A. They may not know the things to challenge. The best M&A attorneys, it's all they do. They transact with the biggest buyers in the world every week. And in many cases, they know the playbook, and they may seem more expensive on an hourly basis, but they just pay off in spades in efficiency and actually getting deals done. If you choose your family attorney, your divorce attorney, your tax attorney, anyone else, you are basically saying, I want this deal to fail, because they will not tell you they're not the right ones. I have had one real estate attorney, after challenging him, say, I'm probably not the right person to do this deal. Yeah, no shit, right? Excuse my language. These people will ruin your deal. So that is number two. And really number three, in from a sense of your team, there has to be an understanding of what the business is worth, right? So that is a valuation expert saying what they believe it's worth, you agreeing, your team agreeing, and most importantly, your investment banker saying, yes, that is achievable in the market based on what I see. So a little overboard of what industry specific, it's industry and size. And I'm going to give you one example. We had a CEO of a public company call in on a Zoom. We set it up with a buyer, and I brought in an investment banker that not only specialized in this particular industry, but had just finished a transaction with this public company the month before. This is how the conversation went. Banker says, hello, Mr. CEO. I'm so thankful of how well our transaction went last month. I know why you want to buy my client. And if we're not happy in the next 15 minutes, you know who I have to call, which are the two competitors that he competed against last time, right? And that buyer does not want to do that. That valuation went up tenfold on that phone call. So that is one of the values of having a really industry-specific representation on your team. I'll stop there, right? Because I could go on and on about how valuable this is, but you really hit on something.
Yeah, I mean, these deals are so complex, and there's something to be said for the guy that's already done it 3 times, right? Or 5 times or 10 times, or that's all he's done his entire career. And you hit a nerve with me on the whole, a divorce attorney or family attorney doing M&A deals, because in our world, the small business, it happens more often than anybody should ever admit.
Yep.
And I've had more than one conversation. I probably use my fingers to count them, not need my toes. But I've had more than one conversation with attorneys privately, after I got the seller off the phone with them and called that attorney's office directly and said, you do realize you're the wrong person for this job. I've had one case where the guy was such a wrong case where I said, when I hang up the phone here, I'm going to call the state board, the state attorney board, or what do you call it, and turn in an ethics violation, because I think you're creating an ethics violation for you to continue in this deal. Yep. The family needs the money. The family is hurting, and you're killing this thing, and there's no way for you to get this thing to an exit. You don't know what you're doing. I'm not going to buy it, and I know that nobody else is going to put up with your shenanigans because you don't know what you're talking about,
Yep.
right? Standard terms and stuff in the LOI, he was like, kicking out, and just things that were boilerplate,
Yep.
right? He just didn't understand, so he kicked them out, and he gave us some form that looked like a real estate transaction. So
I think, I think we're in total agreement on this. It's for us, what we see is if we introduce a business owner to three of the best investment bankers for their business, and let's say all three of them pass on the deal, right? Because these are elite people. They can really take their time. They get the best deals. That's why their success rate is so high. What I think is interesting is when we have bankers decline to represent clients, we get why. What are the problems? And you hear about all these red flags that we didn't quite think about. Well, now you can create a game plan to go fix those problems, take the next 18 months, elevate your valuation, and be the belle of the ball when you go sell this company. Do not be like, oh, well, I can't buy those four, so I'll pick up the last one. That's not how M&A works. So I think we add a ton of value in building those teams. We're essentially building them for free for people. We only get paid if you actually transact, right? And so that's why our transaction rate has to be high for us to have a successful business. We have to choose the best people to work with because we're all, on performance based.
in the investment banking world, one of the things I notice is it can tend to be a little bit of an auction process, meaning that an investment banker gets a deal, they start shopping it out to, they send that thing out to 50 people they think should be interested in it, not like they identify 50 companies they think should be interested in it. 10 of them do, look at the deal room, and four or five of them, because they did a good selection and they showed interest, four or five of them or three or four of them submit an LOI, and it becomes kind of this bidding war type of scenario. Is there anything different from what you're doing, or is it more strategic? Because that's your typical investment banker
Yep.
going out to the public market as opposed to looking for strategic acquirers.
Yes. So there's a big difference, and a lot of it comes down to, if you boil it down, it's privacy.
Mm-hmm.
So with a very industry specific investment banker, what we're looking for when we're doing that bake off, like we have the top three bankers that we're trying to choose for our client, we're waiting for a banker to basically say that they're going to be playing inside baseball on this transaction, which means, as an example, I sold a business that was very similar to this 3 weeks ago, and one company bought it, but four others wanted it. And two of those companies, somebody's going to get fired if they don't win the next auction. I need to call them first and see if we can have a very private transaction at a far above market value, right? So when you find a banker like that, you are creating a buyer list that is very private and very selective based on previous experience. So say 5 names that you're going to. And each one of those 5 there is a personal conversation going. It's, hey, Charlie, I know you lost out on the last one. I know the pieces of the puzzle that you're trying to fill. I think I have one. I think it'd make a lot of sense for you to get a first look here. If you're interested, you got to put a purchase price in front of us that doesn't make us go to market. And so if you have 5 of those conversations and you get a couple of hands raised, you are in the driver's seat and you've kept full confidentiality and privacy about your business, even going to market. Never mind your data leaking. That is very different than a banker that is going to push send on an email to 200 names and wait for companies to say, yeah, I could be interested. And half of them are not. They're just trying to get data. They sign an NDA, which means almost nothing. They get access to your data room, and the process goes. And it's not to say that 30% of those deals don't get done, but the ramifications of all your data being shared somewhat publicly, it can be catastrophic. If your employees find out, your customers find out, that can have negative repercussions to your business. So we are very much, as you can tell, it is all about industry specificity, and it is about inside baseball, personal relationships, highly strategic buyers. If you have that, you're just way better off.
But that said, this sharing your thing to 200 people, you're giving your competitors, so your competitor, especially if it's a strategic purchase, you're giving a lot of people who until you decided you're ready to sell, you'd never want them to see your financials in your unless you're a publicly traded company, you keep that stuff in house, right?
Yep.
I'm
Yeah,
positive that they got far enough down that due diligence process that we actually had to share our customer list by this point,
yep.
right? And then they said no.
That is tough. Yeah. Sharing your customer list really needs to be one of the very last things in due diligence that you do. We make our clients just hold till like 3 days before closing because that is a dangerous thing to give away. It's one thing to share financials. It's another just to let the market know that you're for sale, right? Customers thinking that you're for sale is not a good thing. And there are platforms out there that investment bankers they post your deal to. And we have heard stories of all of a sudden that business owner got 5 new calls. Hey, I heard you were for sale. Would you talk to me? And they're trying to circumvent these online marketplaces for deals. But I'll say it over and over and over. That industry specificity and those relationships are so valuable to get the right deal done and not do damage to your brand if you decide not to sell the business.
So, what is the in this mid market? I know the lower market. What is the sales cycle other than like a 2 to 3 years of prep? Probably the same, right? On a mid market company, if you've never done any prep work, if you started a tech company and you've never thought about selling, unless you engineered it from day one to be ready for sale, you've got some work to do. I get that.
Yep.
But once it's ready and you have a decent, clean data room, what do you see normal as the day I give somebody access to my data room to the day we actually get a wire and I'm an employee of Big Corp? What is that timeline?
Sure. I wish I had that chart, right up in front of me because I had it very recently. So I'll try to do it best from memory. First, what I want to touch on is that the companies in the lower middle market, once they get to 20 million in sales, they typically have somebody in that finance role full time, and that makes that kind of data room, the financials, that preparation a lot easier. So that 2 to 3 years of prep is not probably realistic if you have somebody in that financial role. It can go a lot more quickly. But we really see, kind of the initial phase is if you received an inbound offer, things can accelerate very quickly. So let's put that to the side. If you're deciding that you want to go to sell a business, one, it's picking your team. And maybe that takes a month. You're doing interviews, you're doing preparation, you're telling kind of the need to know people in your organization. If you're a small organization, it's nobody but yourself, right? You don't want to alert your employees that people will think, oh, what happens to me? Do I lose my job? So you don't talk about M&A, except for really with that head finance person, maybe a head salesperson that will be integral to the exit. And it's about choosing that team, that best M&A team that, like I said, could take about a month. Then it's creating the marketing materials. So I'd put another kind of 4 to 6 weeks on your executive summary, your SIM, confidential information memorandum for people. That is the book that you are sending to potential buyers. At the same time, you're creating buyer lists. And those buyer lists are that kind of inside group, the likelies, the strategics, the financials, and then it broadens. And as a seller or a business owner, you want to make sure that you're reviewing all of those names because there are groups on there that you may just say, nope, I want to stay away from. I've done business with those people. I don't like them. I don't want them to know for whatever reason, right? You're going to want to weed that down. And then we're going to market, right? You're the investment bankers having those conversations. And that could be, call it 6 to 8 weeks. What you're looking for is indications of interest. So you'll hear the term IOI, right? An indication of interest. And you're hoping to get, call it 5 to 10 of those. And you had said this previously in the conversation, but we're kind of putting a timeline to it. And then it's the banker, whoever your representative is going back to that 5 to 10 and saying, hey, really appreciate your interest. Is there any more information that you might need because you are not at the top, right? And you're not going to make it going forward. Even the ones with the top numbers, you're really trying to get them up. You're saying like, we view valuation a little differently. How are you valuing this? Maybe you're missing something. Can we share more information with you? And you're trying to negotiate and push everybody up because ultimately you're going to allow, call it 4 groups to actually interview, sit down with the CEO in order to put their best foot forward. And they make that best foot forward in the form of a letter of intent, an LOI. And so you'd be very fortunate to have call 3 of those. We've had transactions where we've had more than that. But that IOI to LOI period put another 3 weeks on that, because everybody is sharpening their pencils. They're asking for more data. This is where your data room becomes really important. Every piece of information, right down to how, not the name of a customer, but how valuable a customer is, what percentage of revenue that particular customer represents. So they're looking for red flags, and they're looking for ways to justify bringing their purchase price up. And I think it's important at that stage to really understand, you want to think about, you're on their side. How should they think about your company strategically in order to justify a purchase price that is higher than what they're, initially presenting? And then you're going to choose a single group. You're going to sign an LOI. You're going to say, I like this group the best. This is the best fit. I like the offer. I like the structure. And an LOI is signed. And that LOI really is the framework for your purchase agreement. So now you're going into this phase that call it another 2 months, maybe 3 months, where we would try to keep it to 60 days. It often goes to 90. And then you can have these like 15-day extensions if it's needed. But you're entering due diligence, and you're also entering a period where you're working on the purchase agreement itself. So it's diligence and documentation. And so the hope is that after that 3-month period, you are at the table signing documents. You've met the management team. You're getting a really good understanding of what the transition is going to look like. Is it a short transition where you're handing over a customer base, or is there real strategic integration with software platforms and teams? But you're working through that prior to the signing of the deal. So what we like to say is, 6 to 7 months feels right. But I was just on the phone with a founder yesterday saying, what I'm uncomfortable with is you don't have 9 months of cash, and you're going to get to the point where we're going to get close to the goal line, and they're going to look at this balance sheet and realize that all they have to do is play a time game, and your price is going to go down. Can you go back to your investors and boost up the cash position that you have, so we don't lose a negotiating position somewhere down the road? So if you think about the typical M&A around 9 months, then you're likely to transact prior to that. I'm sorry to be so wordy, verbose. It's just from an inbound offer perspective, 4 to 5 months is more likely if you're working with us, because we can instantly get you that team. We can instantly drive the valuation and find out if it's real or not. And once it's real, we can have the threat of creating competition right at our fingertips, and push through due diligence, very quickly, bring in the right team members on your side, get the documentation finalized. So think maybe 4 or 5 months on that side.
It's good because a lot of the guys listening to this show, they're familiar with the small to medium business, and it's usually 60 to 90 days from LOI, right? So they understand, when they bought it, it took 60 to 90 days from LOI to, maybe total of 120 days total, to now they've got a new timeline because it's a much more complex structure, and they're selling something bigger, much more complex, and a lot more moving parts there. So,
yeah, I would say that in due diligence, right, if you create a 90-day window, it's hard to reduce that window, but you can have many simultaneous due diligence teams going, whether it's legal, IP, technical audit, right? Those things can happen simultaneously, but it's very hard to reduce the overall due diligence period below 60 days. We've flirted with 45 days before in transactions, but to set the expectation of under 60 is not realistic.
Then you end up with cases like that young lady. I think it was a lady that sold her company and convinced the buyer that they had 400 million users because they had 400 million email addresses in their database.
Yeah.
I think she's going to jail now. I don't remember the name of the company there, but yeah, due diligence, I think, isn't something you should rush. I always joke with my guys, because a lot of these guys in these small to medium businesses, they'll tell you, well, the SBA did due diligence for me because they wouldn't underwrite the loan if they didn't. It's like, no, that's not how this works. Stop.
No.
The SBI covered their butt because you have a lot of assets, and they don't care about once they see that you have enough collateral, you collateralize that loan enough, they don't do as much due diligence as you think they did, right?
Yeah. They're looking to protect their downside, right?
That's all they're doing.
Is a totally different viewpoint. Yeah, we've gone through with buyers that don't know how to do due diligence. And I would tell you that we first thought that M&A transactions get ruined because you have bad representation. And that is certainly a big part of it. There is another group now, which is the buyers are bad. They don't have the money. They don't know how to do due diligence. They haven't bought companies before. And that's part of our playbook. If you receive an inbound offer, we need to know that this is somebody serious. They know how to do M&A, and that it is a real skill set. So that's kind of the second pool that can ruin deals is bad buyers, not knowing how to do due diligence, not knowing the questions to ask, not knowing how to integrate you. That is a recipe for failure. And then for me, the last one really is the seller herself. If she thinks her business is worth $100 million and it's worth 50, you are going to fail. So that's one of the things you can get out of the way really upfront, really understand. We had a transaction last year where we said the business was worth 60, and the founder, she said, "Yep, that's great." We brought an offer of $90 million, and she turned it down because she thought during the process, during the 6 months, she had grown so much that she was worth 100. So she asked for 100. The buyer couldn't get there, and the deal fell apart. And what I really take from it is that business owners need to understand that great transactions are with companies that are growing. So you can't just say, I'm taking my foot off the gas and sell this company. Your buyer is buying your future cash flows, and they want to see that growth rate continue. It's a very hard thing to go through. So it's just another reason to have great representation, because they are carrying the ball. And the less that you can carry the ball as a business owner, the more you can focus on keeping to grow your business. But that is, just so people understand, it is expected that these businesses continue to grow.
It's interesting because in the small to medium space, a lot of times I have to really work with the buyer pool and say, stop, because they'll look at a business and maybe it did plateau, right? And it's
Mm-hmm.
nice, or maybe it took a little bit of a decline. And they come in there with what I call a false sense of ego. They're like, oh, yeah, but the guy's taking his foot off the gas. I'm going to go into X, Y, and Z, and we're going to double over the next 2 years. Like, that guy's run that business for the last 30 years. And you walk in on day one and think you're going to run it better than they have, even if they've taken their foot off the gas,
Mm-hmm.
you're losing a lot of the stuff that man has or that woman has. You're losing all those personal connections, all the time they took all those clients and those customers fishing or playing golf with them, all the dinners they've had at the things, or all the times they've been over for family events. These people have something that you're stepping in and you don't have anymore. I just tell people, quit expecting you're going to turn around and be a turnaround expert, right? Quit expecting you're going to be able to double and triple these companies in the next 2 to 3 years. When I'm looking for something, with big fat margins, and it's actually starting to, it's still growing, because I know I need room to make a few mistakes. I need my learning curve. I need as a new operator, and I try not to be the operator much anymore, but if I'm going to be involved with something, or if our team's going to be involved with something, we got to make sure there's some room for error, because we're going to make mistakes. And that looks like in the upper middle markets, they already know that. Like, they're looking for something growing because they already know that they've made mistakes, and that there's some integration and transition issues that are going to come into play. And if it's not on the right trajectory, it's going to be even harder to get, to make it work. So
I think in the lower middle market, you see buyers, experienced buyers, make sure that the sellers are incentivized for the businesses to succeed once they've transitioned, right?
mhm.
So not only are they describing what a transition period needs to look like, and they're negotiating that, but the potential upside for those sellers, right, can be really significant. If you're selling into a private equity platform, right? If you're a bolt-on, that is a different type of integration and earn-out structure than if you are the platform yourself. I know you've had Adam Coffey on your podcast. He is a fantastic resource about how to play that private equity game. But I do think a less experienced buyer can say, okay, look, I'll give you the cash that you want, and maybe there's some upside for you, but there's no real incentive. And the buyer, if the seller's off, playing golf, and maybe has a board seat, but is really not that incentivized to make sure that you can traverse all of the roadblocks that they faced over those 40 years that you talked about, that they know how to go through the detours. So I guess my point is that structuring a deal is really important for a buyer to make sure that they've got help to traverse the things, the unexpected.
And I think my point was, if the seller's already taken his foot off the gas and it's already kind of burned out,
Yeah.
don't expect some dollar sign at the end of a tunnel to be the accelerated it has him put his foot back on the gas,
Yeah.
right? They've already they've already given you an early indicator of where they're headed on this thing,
Yep.
and B, they're able to willing to live with it, or be able to overcome it some other way. But I see too many people go, yeah, the buyer's going to hang around and we're going to do X, Y, and Z. And I was like, well, you just told me they lost half their revenue in the last 2 years. You think he's going to go work more hours? Do you think he's
No,
going to refoster relationships he's already told to take a hike?
no, he's tired. He's frustrated. It's like
Yeah.
they want out. Ron, it just occurred to me. It's a slightly different topic, but for your audience, when I talk to business owners, I tell them a lot of times, as an entrepreneur, I view entrepreneurship as a career path. So it's not that you have one company and you're going to live with that and you're going to sell it and you're going to sail off into retirement. That you're going to do this multiple times, and every time you complete the journey of you start a company, you buy a company, and you sell it, the next one gets easier. It's not just what you learned, but it's the credibility that you've built for whether it's a customer base or investors, the banks, all of that. The next one gets easier. And so as I think about your audience who is out buying companies and flipping companies, I think what I would encourage is this idea of like, certainly you have to buy right and buy fairly and bring the people who know how that company functions along with on the journey. But when you go to exit, it isn't about absolutely maximizing or waiting the next 6 months. Getting deals done is really important to having success over a long period of time. And I think a lot of people would agree with me once they've gone through that in hindsight. But I've built and sold 4 companies, and now I'm doing my 5th, and everything with kind of age and experience and credibility gets so much easier and frankly more lucrative. So hopefully that lands well with your audience.
Yeah, I like to call it emotional scar tissue, right? You've already been through stuff, so you're not going to react. You've been through three exits already. When you go for your 4th exit, you're not going to have the same reactions throughout the process that you would have now because of the fear of the unknown,
Yep.
right? There's fear of unknown, fear of missing out. There's all these anxiety things that happen when you go through this process that you're numb to it, that you're acclimated to. You got this what I call emotional scar tissue to that, like, yeah, that's just part of the process, right? Their attorney's gonna, look at this and he's gonna kick out 10 or 15 of my terms, and I'm gonna have to go back and explain why we have them in there. And that's just part of the process, as
Yep.
opposed to getting angry or frustrated or or any of the other emotions that come up for the first time you went through it, right?
Yeah. Yeah. You're the bell that rings for me is what are called disclosure schedules, where founders are still like, no, 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 I don't want to tell them that. And that is the opportunity in a legal agreement to just air all your dirty laundry because the lawyers are protecting you by saying everything. So no one can come back and say, you didn't tell us X.
No.
And that is always a challenging shift in an entrepreneur's mind of, hey, I want to air everything. So maybe that's one of those things where like, yeah, we're doing disclosure schedules. I know the drill. And I'm more really talking about, by completing a transaction as an entrepreneur that wants to go out and buy another company. Now, the next founder that you're talking to is you're like, hey, I've done this before. I really enjoy buying and building businesses. We were successful last time. This is what it looked like. Having those experiences under your belt, maybe gets you a better asset the next time, right? Maybe helps you perform better. I think I'm more of an entrepreneur that likes to kind of rinse and repeat,
Hmm.
as opposed to somebody that wants to step up to the plate, bottom of the ninth, bases loaded, and trying to hit a grand slam to never work again. That's just not realistic.
Right. This has been one of those really interesting and educational conversations, but I'm looking at the timer and I thought, wow, we're over. How did we end up over an hour already? So I do need to have us wrap this up.
Sure.
We could probably go on for a couple more hours if we just ignored the clock, but I'm sure you have places to be. And out of the integrity of, I told you that we would stop recording in an hour. We probably ought to call that a show. How do people reach out to you? How do they work with you? What's the best way to contact you?
So email address is todd@exitwise.com. Please look me up on LinkedIn. I encourage a lot of people to use our valuation calculator, on our website. It's free. There are some paid sides, but you can get a lot from the free side. And if what I would say is if somebody is knocking on your door, call us quickly, right? We can get you very smart, make fewer mistakes, get represented, and we're always free, right? We are a free service until you sell your business, with the exception of some valuation services. So yeah, looking forward to helping your audience.
Awesome. Well, we'll call that a show. Hang out for a few seconds, and we'll wrap this up. Thank you for
Thanks,
being
Ron.
here. Sponsored by Dudilio. Buying or selling a small business? Assembling the right team is essential, and that's where Dudilio comes in. They work with individuals, independent sponsors, family offices, private equity firms, and small medium businesses, helping you build the perfect deal team for every stage of your acquisition or sale. And the best part, Dudilio's matching service is completely free. Visit Dudilio.com today and assemble your winning deal team.